The following program is paid for by EG Tax. All opinions or statements expressed on this program are solely those of EG Tax or its guests and do not reflect the opinions of News Radio 930 WBEN or Odyssey.
This program has been pre-recorded.
Hi, everybody. This is Esther Golios, the tax lady from EG Tax. I hope you had a wonderful Thanksgiving. I know we did, and we just want to say how thankful we are to have such a great audience. And, of course, I guess the Bills are going to play again tomorrow, which scares me to death. But, okay, I'm joined in studio with Chris Fabian. Hi, Chris.
Hello, Esther.
Okay, so Tiff's off today, and we're going to be answering tax questions. We're going to do our emails again. If next week we'll be doing live phone-ins again. But if you have any questions, you can go to our website at egtax.com. Ask the tax lady. I'm honored to answer your tax questions.
Yes, we love.
I mean, I have to tell you, I had a question. I had a question. This is just to tell people how confusing it is. I had my own tax question, so I went to the IRS website to pull up a publication. I, honest to God, couldn't find the answer to my tax question. How's that? I mean, they don't answer them over the phone, so they lead you to the website. But, you know, tax law is so confusing that you're not sure you're getting what you're supposed to get, and you could be completely misled. And so anyway, I think that's one of the reasons why our website is so popular, Ask the Tax Lady, because I will answer it in easy to understand language, and if we think we need to talk to you, we have you call us.
That's right. That's right. And,
okay.
And don't forget, we do have our last tax course that starts in beginning of January. We'll meet for 3 Saturdays. It's a crash course, but we will teach you what you need. And, you know, it's a great way to start learning.
That's true. You cannot overlearn what is costing you so much money, because really there are things that you can, if you do A, it's tax-free, but if you do B, it's taxable. I'll give you an example. Let's say that you're short cash to pay bills and you're just thinking, I want to pay off all these credit cards. And so your inclination is to say, I think I'm going to just take the money out of my 401k. Bad idea. 2 things. First of all, if you're under the age of 59 and a half, you're going to pay a 10% penalty. Secondly, it's fully taxable, federal and New York State. So you're looking at sometimes 40% that you're going to pay on that distribution that you're taking, if not more. But if you borrowed against it and you pay yourself back with interest, it's tax-free. And so, I mean, that's where I think that the information that we give you, so either one is right. You can take money out of your pension plan and you can pay the taxes. Doesn't make it wrong, makes it dumb, but doesn't make it wrong. And that's part of what we do is we'll give you have you thought about this?
Right.
You know, and I just think that's so important.
Right. I can't tell you how many people after meeting with them, they go, wow. I never thought of that. Why didn't anybody else tell me this? Why?
Yeah, well, and it can be so. And even if you're talking to a financial planner, if they really don't know tax law, they can lead you down the primrose path. And at the end of the year, when you come to see us, we say, okay, do you have $200,000? Because you did a Roth conversion and nobody told you it's going to be fully taxable. People think if you go from a traditional to a Roth that, wow, it makes it tax-free. It does when you finally take it out, but it's taxable when you do the rollover.
That's right.
Right?
Yep. Got to pay the piper sometime.
Right. Well, okay. So I'm Esther Golios, the tax lady from EG Tax. All of our offices are going to open up mid-January. The IRS is not opening up till January 29th. So when you get your W-2s and make an appointment, get in. As a matter of fact, if you're one of our clients that have been a client for a long time and you think, oh, I don't want to see Esther and Chris in March, call now. Make your appointment now. Even if you don't have all your information, we'll get it going, and whatever we need, you can drop off later, and we'll get it done at your convenience. So now's a good time to call,
Yes,
right?
definitely.
Okay. All right. So we're answering emails. What do we
Yes,
got, Chris?
we got Mark writes in, with such a short window left before 2024 comes to an end, would it really help me to put extra money into my 401k? My wife and I make about $125,000 a year, and right now we've only contributed $5,000 total. I can part with approximately $10,000. What's my return?
So, okay. So first of all, when you say, Mark, that you can part with 10,000, it doesn't, you're really not parting with 10,000. You're just setting it aside
Right.
in a pension plan. You're not parting with the money. It's just money you really can't spend. But just like even in our first example, we said you could still borrow against it once you have that asset. But assuming you're in the 30% bracket, 22 federal, New York State, 30%, you saved like $3,000. I mean, that's a great return on investment.
Right, right. And, he may be able to, depending, I don't know the income limits off the top of my head. He still may be able, if his company says, no, it's too late to change your IRA contribution because his payroll company's lazy.
You mean 401k?
His 401k, yes.
Yeah.
He still may be able to do an IRA.
Right.
So,
But the important thing is, yes, whenever you set aside that money for retirement, and unless you're planning on dying early, you wanna fund your pension. So many pension companies, they don't fund pensions anymore except as a match of what you put in. And that's the other thing that we talk about. Let's say that you got another month and a half before the end of the year and you put in $3,000. The company that, and let's say your salary is $100,000. The salary says, the company says we do a 3% match, which would mean up to your $3,000. So you put in three, they put in three. I mean, that's 100% return.
right, right.
And I'm, the sad thing is, people shoot themselves in the foot because what they don't do really can hurt them. And so you think about stuff that you'd spend $3,000 on, going to Starbucks every day. I mean, you want to set aside money for your pension because that's the best thing to do.
Right, right. It's going to be up to you to have money when you retire.
I mean, because it's not like the good old, unless you're lucky enough to work for New York State or Erie County, or if you're a teacher, you guys are so lucky. You're very blessed, really, because you will have a federal or state funded pension. But the rest of us people, if we don't put it in, we don't get it out when we retire, and retirement age is creeping up more and more and more every year. So because Social Security, it's tough with them giving everybody who's immigrating here illegally Social Security because of Medicare. So there's all these things that the Social Security system is being tapped all the time. And as you age, if you're a younger person, you want to set aside as much as you possibly can for your retirement, right?
That's right.
Okay. I'm Esther Gullius, the tax lady from EG Tax. We're taking your emails today. We're going to take a short break. We'll be back on the other side. Hi, Esther Gullius, the tax lady from EG Tax. We are talking about emails that you guys email us, and we are talking about taxes and how we think about things. And I think you'll find it to be fascinating because what you think isn't necessarily true. And of course, I'm joined in studio with Chris Fabian. So did you have a great Thanksgiving, Chris?
We did. Spent time with a lot of family, started the holiday baking process.
Your mom is such a good baker.
She is.
You know,
And
she really, the cucciadatis and all that kind of stuff.
Yep. And we use the old recipes, that she has, and it's remarkable.
That's how I feel too. If Wegmans don't sell it, I don't buy it. You know what I mean? I don't get it. Your mom is so domesticated, I'm just like the opposite.
but that's okay. That's
For
why
people that
Wegmans
don't
does
know,
it.
Chris is my son-in-law. Think about poor Chris. So anyway, keep him in your prayers. All right. I'm Esther Golias, the tax lady. We're doing emails today. Chris, what do we got?
Sure. Well, this goes back to our beginning conversation and sort of with Mark. I keep calling my financial guy because I still haven't received my RMD. He keeps telling me that it's being processed, but it's been 2 months.
Oh.
What happens if I don't get it by December 31st? Patty.
Well, I'm going to tell you, what RMD required minimum distribution. You got to take it out if you're over the age of 73, or 73 or older. And if you don't, there's a 25% penalty. I mean, I would have a conversation with my financial planner and say, why do I need you? I mean, if you're not getting that money distributed, that's terrible.
Yeah, I mean, it's...
Because he could put you in a 25% penalty.
Yes, yeah. Yeah, I mean, they stopped. It used to be a 50% penalty for not taking it, and then you could request a no penalty because it was a broker's fault. But now they did a 25% penalty, and if there was still an excuse, it goes down to a 10% penalty.
Right.
So,
which is horrible.
yeah.
Well, I want to tell you, you still got a month and a half, not quite a month and a half yet. I would have a conversation with my broker. You do it this week, or I'm going to switch brokers.
Yeah.
I mean, it's terrible.
Right? And how many times we've seen that a lot where people actually, I told my broker, I filled out the forms and I still didn't get it. You know, it happens so often. You do have to stay on top of these companies.
And it's a shame because the broker should know. But speaking of RMDs, what can somebody do if they are somebody that likes to contribute to a charity? And make this completely tax-free.
Well, we're going to make this show alphabet soup right now because they can do a QCD to go with their RMD.
Or their RMD, right.
Right, and a QCD is your qualified charitable distribution. And that's when you take your minimum distribution up to $100,000, so you can take way more than your minimum distribution.
Only out of an IRA.
Only out of an IRA, yep.
So let's say that you have a big 401k, $1 million, okay? And so you say, oh my gosh, I usually give my church $2,000 a year, so I could do part of my required minimum distribution using this money. Not unless it's in an IRA. So you can roll that money over to an IRA, then do the qualified charitable deduction. And that makes it completely tax-free.
I mean, think of if you're in the 22% bracket and your minimum distribution was $10,000, that just saved you $2,200 on the
Right.
federal return.
Right, absolutely. And so all these little, I can appreciate that you don't know what we're talking about, but we know what we're talking about. So if you want to call us, we'll work with your broker to have it happen. But I mean, think about what you would save. You would save. And the other thing is, many of you are in IRMA because you're taking these distributions. Well, and you're also philanthropic. You give money to charity. You move that money that you're maybe writing a check every week to church to this once a year distribution, or if you want to have them do it once a month, they can do that. But it makes it tax-free, number one, and number two, it doesn't show up on your tax return, so it would reduce any IRMA that you might have, right?
That's right. That's right. And IRMA is your Medicare cost out of your Social Security, which is based upon your income from a year ago.
So it's a lot like playing bumper pool. If you hit this shot, then that goes over there and it bumps on there. I mean, because it really is important and it can save you a lot of money.
Right, right. Well, you know, I mentioned 22%, but if somebody's in 12%, right, and they have RMDs, that probably means that their Social Security isn't all taxable yet. So if they just take a regular RMD, they're going to pay tax on the RMD and more Social Security. So it could cost them 12% twice. So it's really costing them 24% on the federal.
Right.
So, I mean, that's a
But
good,
again, if they do the QCD,
right? They
it
say,
eliminates the income.
yep. So,
So again, if you have questions, you know, I guess I really would like people to say, we're going to call them and find out what they're talking. What the heck, Martha? What are they talking about? If you think this pertains to you, we are happy to give you the information, and you don't have to be a client.
Right.
Right?
Yep.
I mean, we just want to get the information out.
Yes, we want to help you. So,
Right.
Yep.
And then at Christmas parties, you can also say, I think those people at EG Tax are really nice. That would be good.
yes.
Okay, what else we got here?
We got Maureen says, my husband and I haven't filed for several years, and yet we have to put in a new high efficiency furnace. Does that mean we won't get the $600 credit?
Hello, Maureen. Right. I mean, here's the thing. These credits that you get for energy conservation are non-refundable credits. So what does that mean, Chris?
That means it only eats your tax liability. It doesn't give you money back.
And so if you have no tax liability, you don't get any of the credit. Now, there is a light at the end of the rainbow. What would be a situation where Maureen would actually get the credit?
Well, I mean, this question's, you know, hopefully they didn't file because their income's under the income threshold. So then they could take out extra money and take advantage of the $600
You mean
credit.
from a pension plan?
From a pension
or
an IRA. Yes.
Right, so they're sitting, let's say they're sitting around with $500,000 in an IRA, and they're 72 or they're 62, and they think, I don't have to do the RMD, I don't have to do the RMD, and so they're not filing a tax return. Well, that's all well and good. With the large standard deduction, you may not but have to file a tax return. But maybe you want to take money out of your IRA, which would get you, so you'd have to file a tax return. But then that liability is covered by the credit. So you've taken out money completely, really effectively, tax-free, because it's covered by your credit. And you still have a month and a half to do that. And if you don't know what we're talking about, we know what we're talking about, and you can call us and we'll walk you through it.
Exactly.
Right?
Yes. Yes.
And that's what's so sad. Like, I'll see people with these big, huge credits, like they buy an EV. Okay, that's great that they bought an electric vehicle. Unless they have some taxable income, they're not going to get to use it.
Right. Right. Yep.
Or solar,
gotta-
right?
Yeah, you got it.
And the solar salesman comes and sells you a bill of goods. You're going to save this money and that money, but not unless you pay taxes.
Right.
So you have a great opportunity to take money out that would normally be taxable, covered by the credits, thereby making it tax-free.
Exactly.
Okay.
So,
All right, what
okay.
else we got?
Barry writes in, I just hit a big jackpot at the casino for $15,000. I am 75, single, and my income is approximately Social Security of $30,000, pension of $15,000, investment income of $6,500, and my rent is $1,600 a month. My friends say I have nothing to worry about tax time because I can use my losses to offset my winnings. Is this true? Well, I'd say no.
Well, of course no. I mean, because he rents.
He rents, yeah. He'll be
And so even if he had $15,000 in losers, right?
yeah.
I mean, that's still not, it might be slightly more than a standard deduction, but not enough that it makes any difference. He's going to end up paying taxes on that money.
Yeah, and the Social Security. I mean,
Right.
he's already paying tax on a little of the Social Security.
So
now
this makes it more.
Yep. Yeah, so.
I know so many times seniors love to go to the casino. And believe me, I think it's your money and you want to spend it. You spend it your way. That's great. But here's the rub. If you win $10,000 at the casino and you know you spent $10,000 making the $10,000, you made zero. Unfortunately, the itemized deduction of $10,000 is limited by your anything over the excess of your standard deduction. So if you don't have enough to come over the standard deduction, even though you lost $10,000 at the casino, it's not going to make any difference on your tax return.
Right, on the federal. The state,
On the federal.
Barry will be good.
Slight. and of course, his standard is Social Security's tax free and his pension's tax free.
Right, on the
Right?
state, yes.
So on the state. So going to the casino when you are a senior citizen with Social Security is not the best thing in the world for your taxes, because you can end up paying taxes that you had no idea that you should pay.
Right,
Luckily, the good thing is you're probably in the 10% tax bracket. So let's say you end up paying $1,500 in taxes. It's a travesty, because who wants you to pay $1,500 in taxes? Not me.
right, especially if you lost it.
Right.
Yep.
And so remember, the income you won is income, reduced by the expenses to make the income as an itemized deduction. But if you can't come up to the amount that they're going to give you as a standard deduction, you will get no benefit for that. Anyway, I'm Esther Golias, the tax lady. We're going to take a short break for the news. Hi, this is Esther Golias, the tax lady from EG Tax. Thanks for listening. Don't forget, all of our branch offices open up this tax season January 15th. In between now and then, we're completely accessible. Call us at 632-7886 or go to our website at egtax.com. We want to help you. And of course, I'm joined in studio with Chris Fabian, and today we're just doing emails.
Yes.
Okay, what else we got, Chris?
Okay, Tim writes in, I own 2 rental properties. I've had them since 1985. Needless to say, I'm very tired of dealing with the headaches that come with it, and especially the new laws giving the tenants more rights than me. So I'm in the process of selling them. I have contracts on both properties for a total of $550,000. How much am I in trouble come next April?
Well, like $140,000, right? Because the maximum you're going to pay on the federal is, if the whole 550 is taxable, I'm assuming most of it will be, except your expensive sale. But just for simple math, you'd owe about $110,000 on the sale on the federal, and then on New York State, you're going to owe like another 30. So that's about $150,000. But there's a way around it, isn't there?
There is. Since you haven't gotten the cash yet, you could still do an exchange. And I know some people might be going, but he doesn't want to be a landlord anymore. Well, he can exchange into student housing. He can exchange it into a Dollar General or a Rite Aid building.
Passive passive income, right?
Yep.
In other words, he can sit home, he can exchange that sale, the income from the sale, into a commercial property that somebody else is managing. He's down in the Caribbean drinking pina coladas, and the money's just coming in to him into his account, but he doesn't pay the $140,000 in taxes until he sells it. And if he never sells it and his kids inherit it, they get a stepped up basis. They can sell it and not pay taxes.
Exactly. So, I mean, it's a great way. You get the monthly cash flow, and you're not paying the big tax dollars. So,
Right. I mean, so, and I know you don't understand it, but we understand it, and we'll point you to somebody that will show you your options. And the truth is that instead of paying all that money up front, you basically defer it until, if you are lucky enough to pass away, your kids get it at a stepped-up basis, and they don't have to pay taxes.
well, like you say, defer,
Die. Right.
Yes. So,
And again, and you don't and let's say that you don't want to defer all of it. You can actually do partial. You can do a partial exchange,
yep.
right?
Yes.
Okay. What else we got?
My mom passed away last June. Up until then, she worked a part-time job and made $9,000. She did have Social Security of about $12,000 and a small pension of $5,000. She was 67 years old. By the way, she also had stock dividends of $3,000. can I just let this go without filing her 2024 return?
What you say, Chris?
I would say you better file that return.
Well, probably there was withholding from her wages, right?
Yep.
So you want to file to get the money back. Even if she has no liability and she doesn't have to file, you still want to file to make sure you get her a refund. And you, as the trustee or executrix or executor, ends up with the refund that goes into the estate.
Right. Yep.
And then after that, she passed away in June. How about the money that she got after her death?
Right. Then there's the estate return.
Right. So she may no longer have the Social Security's not would have stopped. There wouldn't be wages, but her pension may have continued, and her investments may have continued.
Right. Especially her investments.
Right. And so you have to do a fiduciary return for her.
Yeah, that's the thing that people don't realize. After somebody dies and they have the investment account, I know you have to wait till after probate, but that means that's income coming into the estate. And so that is the 1041 that has to get filed.
So for the half a year, you're going to do her individual return, and she may have zero liability, but she gets a refund because of her withholding, state and federal. That's my assumption. And then after that, you have to do the 1041 for the balance of the year and the income that came in that's taxable. And obviously, no Social Security's coming in. I'm assuming maybe if she's got a state pension, maybe still that's coming in, and her investments. But even if it's just her investments, the estate exclusion is what, $600?
Yes.
So she's still going to owe taxes. The estate will.
Right. And who's
So
liable for
you
that?
got to file that, and you're liable for that.
Yep.
Right.
Yeah.
Okay.
Yes. Okay, so then we got Paul. He says, I'm 70 and my wife is 63. She is still paying for her own health insurance with the high deductible. I heard we might qualify for some deduction because of this. What is it? We are both retired and living on our pensions, which total $40,000. I am just starting to take my Social Security. So far in 2024, I only received $4,000 in Social Security. Paul.
Okay, so let's sort this out. So she has a high deductible insurance policy. What could she take as an adjustment?
Well, she could do an HSA.
Right.
So she can put money away in a health savings account for her. So that would be $3,850.
So here's the thing. If she hasn't set it up yet, if she didn't set up an HSA, does she lose that deductibility?
No, she has to the end of the year to do that.
So she can go fix it before year end. And the HSA kind of works like an IRA, right?
Right. You keep it out there. You don't have to use it. You don't lose it. It just keeps rolling over and over. So then
Now, had she turned 65, then she wouldn't qualify anymore because she would have gone on Medicare, right?
correct.
But because she's under the age of 65, she's paying her own health insurance with a high deductible. She can set up an HSA, and that would make it deductible. And so for anybody that's listening, and that's your situation, and it happens a lot, go do the HSA because it ends up to be an adjustment on your tax return without itemizing.
Right. And another thing she might be eligible for, we really would have to talk to Paul and his wife, is I'm hoping they have health insurance through the exchange for her, through the New York State marketplace, because then New York State would be helping her pay for most of her health insurance, because with that income with the family of two, she may even still qualify for the essential plan, which would have only been $25 a month, which she didn't need an HSA.
That's true.
But
That's true. So many people, though, that are New York people are unaware that the New York State of Health is really can be a godsend because you don't have to pay the big premiums. And so to assume that you don't qualify really is to your own detriment. So it's true that in this situation, she might lose a deduction of $3,000, but which multiplied by her tax bracket is going to save her $300. But she might have, because she qualifies for New York State of Health, she might save $3,000 in payments to the insurance company, hard dollars.
Right. Yeah.
And it only takes a minute to find out if you qualify.
Exactly.
Well, maybe 5
Maybe a little bit more.
Right.
Yeah.
But the thing is, if you're somebody that's under normal retirement age and you're paying your own health insurance, you can give EG Tax a call. We work with the financial guys, and they have a whole section of specialists that will help you to see if you qualify for the New York State of Health. And even if you don't like it that it's called Obamacare, look, you're in New York State, enjoy what you can get, because it's an absolute benefit for you.
Yeah, don't complain that all these other people are getting all this stuff because they live in New York for free. Well, you could be entitled
You
to it
could
too.
right? But these other people that need to get benefits, they're out beating the bushes to find out what's available. And maybe you're lucky enough to be more affluent. You think, I wouldn't qualify. You'd be surprised.
Exactly. Yep.
Okay, what else we got?
Okay, so Shelley writes in, Tax Lady. My son and his wife are trying to have a baby and are going to try in vitro. It is very expensive, so I'm offering to pay it for them. Can I use this as a medical expense on my return?
Okay. Well, so if the reason why you're paying for medical is because the only reason you're supporting them, and the only reason you can't claim them is they make too much money. So if you're paying for the in vitro, it's not going to be deductible. However, why not gift them the money
Right? Because
so they can pay for in vitro?
right.
Because up to $18,000 per person per year, $36,000 for the two of them. It's complete the gift tax. You don't have to do a gift tax return, and you're good to go.
Yes. So I mean, yeah, and that's you're being nice, and that's awesome. That's a wonderful thing, But do it the right way, where somebody could save some tax dollars.
Right, and that's even a maybe, right?
Yep.
Because the medical is going to be reduced by 7% of their 7.5% of their adjusted gross income. So if they make $100,000, $7,500 is going to come off that $10,000 that they're paying for in vitro. So it's true they'll end up with a $2,500 deduction plus any other medical that they incurred last year.
Right.
But then all of that is subject to the whole standard deduction thing. So you may make it on the state, and you may not make it on the federal. But I would say, like, if you have to have dental stuff done because of all this in vitro, get all of your medical together as much as possible.
Right. I mean, and your prescriptions, if you need it, like, I know if you give them the money, they might not need eye surgery, but maybe they want eye surgery, laser eye surgery. That would count too. Or if it's for someone who's older, do your cataract surgery, hearing aids, all these other expenses that people don't realize are medical.
In other words, you want to load it up because you've already met your 7.5%.
Exactly.
Right? Okay. I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break. We'll be back on the other side. Hi, everybody. This is Esther Golias, the tax lady. Hope you are stuffed with turkey. I love turkey. A lot of people I was watching some programs this week. A lot of people said they don't like turkey. I like turkey.
Turkey is good. Well, hopefully they're awake from eating all that Thanksgiving turkey.
Tryptophan. But, I mean, give me a piece of turkey with that relish dressing. Oh my gosh, that's so good. Anyway, I think I must be hungry. I'm Esther Golias, the tax lady. I'm with Chris Fabian. We're answering your emails today. Don't forget our offices open up mid-January. The IRS isn't open up till the end of January, but we're going to get you all set. So, boom, as soon as we can get them to the IRS, we're going to get your taxes filed. In the meantime, if you got questions, the IRS may not be answering your questions, but we will. You can get us at egtax.com, or you can call our office. We love to help you. So, and what do we got? Another email, Chris.
Yes, I operate a small business without any employees. My bottom line is this year it's going to be around 45,000. Most of my help are independent contractors, so they pay their own way. I am a contractor / maintenance company and do yard work in the spring and summer and snow removal during the winter. Any suggestions to help get rid of some of this money?
Well, he probably, I mean, I'm reading between the lines, but the first thing I would make sure is that all those subcontractors are really subcontractors,
Oh, amen, sister.
right? So a lot of times people say, oh, just put them on a 1099. Okay, well, you can put them on a 1099, but if you're exercising control, giving them the equipment, you're telling them what you're going to pay them per hour, they cannot substitute who's doing the work. You hired them to do the work. That is a common law employee. So all of these 1099 people really should be on a W-2. And that'll help you to get rid of some of that money, right?
Yeah, better you do it right than them coming
Right,
in. And
because you don't want the IRS to audit you and say, hey, all these people that you got working 1099s, they're employees, and and we're going to penalize you for all that.
yeah, and then the penalty isn't deductible because it's a
Right.
penalty.
Because it's a penalty. So, the sad thing is when you see somebody that's kind of getting away with murder, it's good as long as nobody ever investigates the murder, right? But if they investigate the murder and they find out that that's what you've been doing, then it ends up to be terrible.
Yes.
So I just think that the best thing you can do is remember, if these people are bringing their own equipment in, coming and going as they want, they can substitute or they want. They are not under your tutelage or your direction, and they're doing other maintenance work for other people, then that's one thing. But if you really are controlling them, they are employees, and I would suggest you call us so we can get you squared away.
Yep. Yep. And then hopefully he's not taking cash either and not reporting the cash because, yard work and snow removal, a lot of those people do it for cash on the side. Ha,
Right.
ha, ha. So because that could get him in trouble too. But then he's paying, even if, say, he paid these contractors cash and he's not reporting it, he just paid their taxes.
Right. And people don't understand that. So you're a small business owner and you say to your employee, I'll pay you $20,000 under the table. Okay, well then that's great. So this person's got the $20,000 and they're happy as a clam and they're not going to claim it. Well, guess who claims it on their tax return? You do, because you can't take it as an expense.
Right.
So somebody is paying the taxes, you are.
Right. And let's see, you have income tax and self-employment tax. So on that $20,000, you just paid approximately $6,000 in taxes on money you don't
that
have.
You didn't need to do.
Yeah.
So, people think they're so smart, like they're really, they're so smart, they're shafting the federal government. Well, you're not. Many times you're shafting yourself. And that's part of what we want to do. Knowledge is power. And sometimes when you're listening to your friends over the backyard fence, they're not giving you the right information at all.
No.
And a lot of the other thing is I see is people, they're frustrated because they don't know how to do it right. Well, we'll help you to do it right.
Yes, for sure. You may not like it, but you know what? It's right.
Well, I think
and
in the end, they do like it.
yes.
In the end, they do like it.
You're right.
Okay, what else we got?
Ellen writes in, Esther, I see the commercial all the time for donating your car to charity. You know, the one with the very annoying jingle? How does donating a car help you on your tax return?
1877 Cars for Kids.
That's probably the one because I can't stand that one.
Well, okay, so you can give your car to charity, but you have to understand that whatever income you get is multiplied by your tax bracket. whatever expenses you incurred is reduced by your tax bracket, is deductible by your tax bracket. So if you give a car that's worth $5,000 to charity and you're in the 20% bracket, the real dollars that you're saving is $1,000 if you can itemize.
Right.
And
right.
that's a big if.
Right. And it doesn't go by what you think the car is worth to. It goes by if the charity uses it, they have to get it appraised, and they give you a notice saying, thank you for your car. We had it appraised, and it was only worth $2,000. So you only get a $2,000 write-off, not a $5,000 write-off.
Right.
But then if they auction it off.
And again, if you qualify to itemize. Right.
Right. And then also most of these places auction off the cars, but you don't get that deduction until it sells in auction, and it's what it sells in auction for is your charity write-off.
Right.
So there's a lot to it. It's not a simple little thing. There's a lot into it when you donate a vehicle.
But when you're taking a look, for instance, that your standard deduction might be $32,000, until you get to $32,000, you don't beat what they're giving you automatically.
Right.
Now, this, I think, one of the things that Trump wants to change is the elimination of the floor of the state and local income taxes, where it was limited to $10,000. That will really help New Yorkers.
Right.
Really help New Yorkers. So New Yorkers will be able to itemize again. But this year, through 2024, it's still the way it was. So if you're giving away a vehicle, let's say that it's worth $20,000. Well, again, if you're in the 20% bracket, you're actually like selling the vehicle for $4,000. That's all you're going to get. You're better off, truly, taking the car and selling it, even for $16,000, because that's $16,000 hard dollars, as opposed to $4,000 tax savings. And people don't understand that at all.
Right. So,
Okay.
yes. And well, speaking of Trump changes, if Donald Trump makes tips tax-free, just how can that work? I'm a server and make over $40,000 a year in tips. Does that mean I won't file anymore? Really seems too good to be true.
Well, I kind of think it is too good to be true. I mean, I don't know what they're going to do, but obviously they talked about, when Trump was on the political stump, that they wanted to make tax on tips tax-free to people that are servers, that work in the public serving. The thing is, it wouldn't be fair to everybody else to make all of those tips tax-free. So I'm thinking I think this is Esther's tax law, which doesn't count for anything. But I think that what they'll do is they'll say, if you make less than X amount of dollars, then your tips are tax-free.
And I'm going to go back to Morton's question a little. That would be if she claimed all her $40,000 in tips, because how many servers actually report all their tips? I hate to say that.
They have to do that calculation. The
8%.
Right, you're right.
I guarantee you,
right.
She
That's
probably
true.
only claims $10,000 a year out of her $40,000.
Yeah, that's true. But that is something that they promised. I don't know how they're going to make it happen, but I'll tell you this about me. As soon as I hear a bill has passed the House, the Senate, and it went for signature, I download the bill and I read it, so that I know what they're talking about. Now, I may miss a nuance here or there, but basically, before it goes to where they make all the laws, in other words, here's a law, and then they put it into how it's going to be administrated. I already know what's going to happen, and believe me, we will let you know.
Right. And, another thing is Trump said that he was going to try to make Social Security tax-free. Maybe that just means they're going to change the calculation to finally throw in inflation.
Right.
Because
right now, if you make if your half your Social Security is added to your other income, and you're married filing a joint return, and that exceeds 32,000, then part of your Social Security is taxable. So that 32,000 has been the floor since the beginning of time.
Right.
I mean, all this inflation went up. It ought to be 60, 70,000, right?
Right.
That's what the floor should be if you took a look at inflation. So who knows? And again, we will let you know, right?
That's right. Yep.
All right. So if during the week you get love letters, you have gotten letters from the federal government, and you kind of put it in the circular file, look at you, unless you deal with those letters that they sent you, you may not get a refund next year if you have one coming until that's dealt with. EG Tax is here to help you. So we have 32 area offices. You can go to our website to ask the tax lady. You can enter your information, and we'll help you. So thanks for listening. Until next week, I'm Esther Golias with Chris Fabian. Talk to you later.
The previous program was paid for by EG Tax.